Hi, welcome to Digging to China. I'm Dong Shong. Thank you for tuning in. Your support means the world and plays a crucial role in the YouTube algorithm. Liking, sharing, and subscribing not only show your support, but also help YouTube recommend my videos to a broader audience. Thank you very much. In the world of finance, China once stood out as a huge player, attracting investors with its promise of big growth and lots of market opportunities. But behind all apparent success, there are a lot of complicated and uncertain things going on that make even big supporters of investing in China think twice. With big names like Goldman Sachs warning about it and investors worldwide reconsidering their plans, it's important to take a closer look at what's causing all this doubt. From unpredictable rules to tensions between countries, every aspect of China's economy and politics needs careful examination to figure out if investing there is really worth it. Around mid-2021, Goldman Sachs started saying that investing in China's stock wasn't a good idea in many conversations with clients. This came after a string of regulations and government interference in big initial public offerings like Ant Group and DD Global. China's sudden move to change high-growth tutoring companies into non-profits caused their stock prices to plummet. When JP Chase analysts said that Chinese internet companies were uninvestable in 2022 and downgraded some stocks, it led to a loss of about $200 billion in US and Asian markets. Although the downgrades were reversed after 2 months, people still felt uneasy. Xi's consolidation of power in October 2022, when he secured a third term as Communist Party chief surrounded by close allies, scared of some international fund managers. They worried that his increased executive power would make policy mistakes more likely. Many of them still haven't returned to investing in China. Does China care about the exodus of foreign investments? To some extent, yes. Xi's government appeared indifferent to the concerns of global investors as it pursued measures to restrain what it terms as disorderly expansion of capital. This regulatory initiative aligned with Xi's broader campaign to rein in tech conglomerates and advance the agenda of common prosperity aimed at fostering a broader middle class in anticipation of the 2022 Party Congress. However, there were instances of unexpected, ostensibly market-friendly actions. Notably, there was a sudden reversal on COVID restrictions and the lifting of a 2-year ban on Australian coal imports. Additionally, there was a relaxation of oversight on tech giants such as Tencent and DD, alongside a moderation of stringent regulations on developer borrowing. In December 2022, a speech delivered by Xi in closed settings underscored to top officials the significance of attracting and retaining foreign investments. Furthermore, last year witnessed a reception of numerous foreign leaders and business delegations, including those from Germany and France. Nevertheless, it has become evident that Xi prioritized addressing perceived threats to national security, particularly in response to US sanctions targeting crucial industries like chip manufacturing, aimed at safeguarding US dominance. The enactment of a new counter-espionage law last April, followed by raids on international consulting and due diligence firms operating in China, further underscores this stance. After enduring 3 consecutive years of decline, China's stock market presents an enticing opportunity for investors as valuations reach unprecedented lows. Once considered among the world's priciest, Chinese equities have now become some of the most affordable assets available, despite being one of the worst performing markets in recent years. With a staggering slump exceeding 40%, this downturn has led to valuations that are sparking optimism for potential rebound in the upcoming year. However, it's crucial to exercise caution as the market may not have yet reached its lowest point. The benchmark CSI 300 index, which tracks stocks listed on the Shanghai and Shenzhen exchanges, has had a lackluster start to the year, plummeting 42% from its peak in 2021, trading a mere 10 times forward earnings. This index boasts valuations that are less than half of those seen in global benchmarks such as those in the US and Japan. Furthermore, with a price-to-book ratio of 1.2 times, it stands at only a third of the level observed in the S&P 500 index. Despite these attractive valuations, some of the most promising sectors such as electronic cars and AI-related technology stocks have lost their allure. The Chinese electric vehicle market finds itself embroiled in an intensifying price war, resulting in squeezed profit margins for industry players. Moreover, prominent companies like NIO are grappling with losses amidst this challenging landscape. Additionally, US export controls have restricted access to advanced semiconductor chips, posing a threat to the development of AI technologies in China. As such, while the Chinese stock market may appear ripe for investment, it's essential to carefully evaluate the risks and uncertainties inherent in these sectors before diving in. Goldman Sachs Chief Investment Officer Shamin Mossavar-Rahmani advised against investing in China despite the recent declines in its stock market. She highlights concerns such as expectations of a steady economic slowdown over the next decade, uncertainties in China's policymaking, and unreliable economic data. China's emphasis on information security and restrictions on data movement further contributed to investor unease. The recent suspension of press briefings by the country's premier adds to policy uncertainties. While short-term stimulus measures may be expected, challenges persist in China's real estate sector and doubts linger about the accuracy of official economic growth figures. Mossavar-Rahmani suggests caution and recommends against investing in China at this time. Here are my takeaways, not from an investor's perspective, but rather from a person who knows a few things about CCP. First and foremost, we confront a fundamental question: mirage or reality? China's ascension to the status of an economic powerhouse has been nothing short of spectacular, paralleled by a frantic surge in its stock markets, which has fostered the perception of China as a beacon of modernity and advancement. Yet, delving beneath its glossy exterior reveals a labyrinth of intricate regulatory mechanisms and a pervasive state intervention that frequently contradicts the market's facade of dynamism. This stark contrast between perception and the reality serves as a stark reminder of the imperative for investors to proceed with prudence and circumspection when venturing into the complexities of China's financial markets. Secondly, hostility towards foreign enterprises. Xi Jinping's firm stance towards foreign enterprises has sparked concerns among investors, particularly due to the heightened tensions between China and the West. This apprehension is further compounded by concrete examples of China's hostility towards foreign business. In March last year, Chinese authorities abruptly shut down the Beijing office of the US-based Minsk Group. Following this closure, there were reports of raids conducted by authorities on other foreign consulting research firms such as Bain & Corporation and Capvision. These actions by Chinese authorities underscore the challenges faced by foreign enterprises operating in China, highlighting the regulatory uncertainty and the political risks that persist in the country's business environment. Thirdly, China's economy finds itself amidst turbulent waters, grappling with a myriad of challenges from various directions. Despite official assurance of resilience, the country is confronting significant headwinds that threaten to impede its economic trajectory. The lingering repercussions of the COVID-19 pandemic, compounded by mounting difficulties in the property sector, cast a shadow over China's economic recovery efforts and raised concerns of prolonged stagnation. The absence of clear and cohesive policy measures further compounds uncertainty surrounding China's economic prospects, leaving investors wary of the country's ability to navigate these tumultuous times effectively. Fourthly, the Taiwan factor emerges as a significant concern in the geopolitical realms under Xi Jinping's leadership. His assertive rhetoric and aggressive actions in regional disputes, notably concerning Taiwan, have heightened the tensions in the Asia-Pacific region. The looming specter of potential conflict casts a veil of uncertainty over China's geopolitical landscape, further complicating investment considerations for foreign investors. In closing, and to reinforce my argument, I'd like to highlight two intriguing pieces of news. Firstly, last weekend, during the China Development Forum, there was a notable display of openness as China's Minister of Commerce warmly received Lisa Su, the CEO of American tech giant AMD. This gesture underscores China's commitment to international engagement. Secondly, there is another noteworthy report from the Financial Times, which has garnered widespread attention from global media outlets. It's a much bigger story compared to the meeting between the Minister of Commerce and AMD's CEO. The Financial Times reported that China is directing government agencies and state-owned enterprises to avoid Western software systems when procuring computer equipment. This directive marks a significant shift in China's technological landscape. China has introduced guidelines to phase out the US microprocessors from Intel and AMD from government personal computers and servers. The Financial Times reported on Sunday. The procurement guidance also seeks to sideline Microsoft's Windows operating system and foreign-made database software in favor of domestic options. Government agencies above the township level have been told to include criteria requiring safe and reliable processors and operating systems when making purchases, the newspaper said. This signifies that Intel and AMD processors will gradually phase out from personal computers and servers under the purview of the Chinese government, as China intensifies its effort to replace foreign technology with domestic alternatives. The convergence of these two news items holds significant relevance and impact. On one front, Xi Jinping's effort to court foreign investors are evident as he personally meets with foreign CEOs like AMD's, signaling a push for greater foreign engagement. However, concurrently, a conflicting directive emerges behind closed doors, an internal mandate prohibiting the use of AMD servers. This dual narrative paints a vivid picture of China's present foreign policy landscape. While it acknowledges the necessity of foreign openness and investment, it also underscores the intensification of external conflicts and espionage crackdowns. Both directives stem from Xi Jinping's leadership. Yet, in implementation, the Chinese populace adheres to the political security maxim, prefer the left over the right. While Xi advocates for both openness to foreign investment and crackdowns on espionage, officials in the society tend to prioritize the latter due to security concerns or national sentiments. Therefore, when confronted with Xi's dual directives, China tends to lean towards reinforcing internal measures rather than emphasizing foreign engagement. This phenomenon sheds light on China's present international image and macroeconomic context, painting it as an uninvestable China. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.